Hello and welcome to Metal Edge YouTube channel. The market just sent a signal and it wasn't a harmless wobble. It wasn't the kind of dip people laugh off and buy with confidence. It was a blink. The kind that tends to happen when something subtle but structural begins to shift. Not a crash, not panic, just enough movement to suggest that the staircase many investors think they're climbing might actually be an elevator waiting to drop. Over the last several weeks, the most crowded trades didn't break all at once. They unraveled in sequence. One sector peaked, then another. Mega cap tech rolled first, followed by high momentum growth names, crypto, and even areas traditionally treated as safe, like shingles lifting off a roof before the storm collapses the frame. Leadership didn't fall together, it peeled away quietly. That pattern matters. Most people wait for a single dramatic moment to tell them when to worry. A huge red candle, a shocking headline, a clear invitation to panic. But major market tops rarely announce themselves that way. They tend to arrive during periods that still feel comfortable, even celebratory. The music is playing, prices are high, but liquidity, the thing that actually keeps the system alive, is starting to thin. To cut through the noise, we did something deliberately simple. We lined up peak dates across the most crowded trades. Big tech, consumer favorites, banks, chips, AI narratives, crypto, and defensive assets. Then we asked a blunt question, not about prediction, not about storytelling, but about pattern. Do clustered peaks like this usually mean something? The answers weren't comforting. One analytical model called it what it looked like, a rolling top. Another warned against overfitting and urged caution. A third acted as referee. The conclusion was nuanced but clear. The surface of the market still looks healthy, but underneath it, the structure is fatigued. A strong bull market moves together like a band in formation. When that formation breaks, it doesn't happen all at once. One row slips out of rhythm, then another. The music continues, but coordination fades. That's what a rolling top looks like in practice. The most stretched and speculative trades lose momentum first. Then the widely owned leaders stall. Eventually, even late cycle beneficiaries stop advancing. That's what we're seeing. Highly speculative growth peaked early, then came cracks and everyone owns these trades. More recent late cycle areas like banks and broad indices held up, masking the weakness beneath. Rotation creates the illusion of strength, but rotation isn't infinite. If the rally were as robust as headline suggests, leadership wouldn't be taking turns breaking down. Markets don't run on confidence alone. They run on liquidity, and when liquidity tightens, the strongest participants don't accelerate, they step aside quietly. This is where most people make the second mistake, focusing only on price. Price grabs attention. Plumbing tells the truth, so we examine the plumbing. The yield curve, especially the relationship between short and long-term rates. Central bank communication versus market pricing. The effective policy rates. Repo activity, where financial institutions borrow overnight liquidity to function. When these elements were added to the analysis, the tone shifted from uncertainty to concern. Many investors obsess over yield curve inversion as the recession signal, but historically, downturns often arrive after the curve starts to steepen again, not because conditions improve, but because markets begin pricing rate cuts in response to stress. When short-term yields fall sharply while policy rates remain high, the bond market isn't celebrating. It's warning that something is breaking. That's the key tell. If growth is strong, short-term yields shouldn't collapse. When they do, the bond market is effectively saying policymakers are behind the curve. That disconnect matters. At the same time, funding markets began to show strain. Repo activity didn't explode, but it revved higher in a way that suggests increasing demand for cash. Repo is the financial system's overnight pawn shop. When it gets crowded, it means institutions are scrambling for liquidity. That kind of stress stays invisible until it doesn't One interpretation argued this was a full liquidity peak. Another countered that some of the pressure was seasonal and not yet systemic. That disagreement is important. Markets don't reward drama, they reward discipline. But here's the tension. You can be technically correct and still be too late. If a building smells like smoke, you don't wait for the roof to collapse before exiting. Timing matters, but so does preparation. So instead of predicting collapse, we focus on a short list of signals that actually matter. First, leadership fractures. When money rotates from growth into defensive assets while indices remain elevated, it can signal late cycle behavior, not strength. Second, the bond market's message. When bonds price cuts while policymakers project confidence, pay attention. Markets price risk. Not speeches. Third, funding stress. Emergency facilities don't get expanded because everything is fine. They get expanded because officials don't want to be unprepared. Fourth, credit spreads. Credit doesn't speculate, it assesses risk. If high-yield spreads widen while stocks remain calm, that's structural warning, not noise. Historically, major market breaks don't start where everyone is watching. They start in the boring corners: funding markets, credit conditions, liquidity channels. Equity prices react last. This brings us to the AI debate. AI models aren't crystal balls. They're mirrors. They reflect data and assumptions. When one model turns aggressively bearish and another urges patience, the value isn't in choosing sides, it's in understanding the risk landscape. Late cycle environments often feel normal until they don't. Complacency, not fear, defines the final stage. That's when leverage hides everywhere. Options, margin, structured products. Small shocks turn into fast cascades. The mistake people make is going all in on one outcome, either extreme bearishness or total denial. The smarter response is scalable, positioning, adjust size, reduce concentration, manage leverage, build triggers instead of narratives. We don't abandon upside exposure because markets can remain irrational longer than expected. But we don't ignore risk signals either. Cash becomes optionality, not fear. Preparation becomes the edge. If this market is truly topping, confirmation will appear first in the dull data curves, spreads, funding, not headlines, not social media, not the prettiest chart on your screen. That's the framework. Facts first, interpretation second, risk management always. We may avoid a historic crash, or we may see a sharp repricing that punishes complacency and excess leverage. Those outcomes aren't mutually exclusive. The goal isn't prediction, it's resilience. We stay invested, but we harden the ship. We respect trends, but we stop worshiping stories. We take profits when leaders stop behaving like leaders. And above all, we avoid being forced sellers. Because in markets, you don't rise to the occasion, you fall to your preparation. There's another layer to this that doesn't get enough attention, and it sits at the intersection of history, incentives, and behavior. Late cycle markets don't fail because people suddenly become pessimistic. They fail because confidence becomes structural. Risk stops being priced dynamically and starts being assumed away. When that happens, fragility grows quietly, not visibly. If you look back at previous late cycle periods, 2000, 2007, even parts of 2018 and early 2020, the warning signs didn't arrive as panic, they arrived as disconnects. Stocks pushing higher while credit hesitated. Volatility staying suppressed while funding stress crept in. Policymakers projecting confidence while markets positioned defensively underneath the surface. The common thread wasn't fear, it was disbelief that anything could go wrong. That disbelief matters because markets are not just pricing fundamentals. They're pricing when everyone expects stability, positioning becomes crowded in the same direction. Crowding itself becomes risk. It doesn't require a dramatic catalyst to unwind. It only requires a reason for liquidity to pause. When liquidity pauses, price discovery returns, fast and often violently. This is why late cycle drawdowns tend to feel different from early cycle volatility. Early in a cycle, pullbacks are bought aggressively because balance sheets are strong, leverage is low, and liquidity is expanding. Late in a cycle, pullbacks hesitate. Buyers become selective. Each rebound is narrower. Each rally depends more on fewer names. That narrowing is not random, it's a signal that capital is becoming cautious even while prices remain elevated. Another underappreciated factor is how modern market structure amplifies these dynamics. Passive flows, systematic strategies, volatility, targeting funds, and options-driven hedging all reinforce trends until they don't. When conditions shift, these same mechanisms can flip from stabilizing to destabilizing. Volatility doesn't rise linearly, it gaps. Liquidity doesn't fade gradually, it steps back all at once. That's why watching funding markets is critical. Funding is the oxygen of leverage. When funding becomes uncertain, even strong assets can sell off, not because their fundamentals changed, but because balance sheets need to shrink. Forced selling doesn't care about stories. It cares about margin, collateral, and timing. This is also where the central bank dilemma becomes acute. Policymakers are tasked with maintaining stability, but their tools work with lags. By the time rate cuts are clearly justified, the market has often already repriced risk. That's why markets sometimes sell off into easing cycles. It's not a paradox. It's recognition that policy is reacting, not leading. From a positioning perspective, this creates a difficult environment. Staying fully aggressive assumes liquidity will remain abundant. Going fully defensive assumes an imminent breakdown. Both assumptions can be wrong at the same time. That's why posture matters more than prediction. Posture is flexibility. It's having exposure without fragility. This is also why narratives become dangerous late in cycles. Narratives simplify complexity, they reduce uncertainty into confidence. But markets don't reward confidence, they reward adaptability. The more confident the crowd becomes in a single outcome, the more asymmetric the risk grows against it. None of this guarantees a crash. Markets can remain elevated longer than expected, but it does suggest that the distribution of outcomes is widening. Upside may still exist, but downside is no longer theoretical. It's conditional. And conditional risk is what disciplined investors respect. The real mistake in environments like this isn't being bearish or bullish. It's being inflexible. It's assuming tomorrow will look like yesterday because yesterday worked. Late cycles punish that mindset more than any other. So the question isn't, will the market crash? The better question is, if conditions change quickly, am I positioned to survive and adapt? That's the difference between participants and professionals. Professionals don't need certainty. They need optionality. This is why we continue to watch the unglamorous indicators, not because they predict headlines, but because they reveal stress before it becomes visible. Yield curves, credit spreads, funding markets, and breadth don't tell stories, they tell conditions. And conditions always matter more than opinions. In the end, markets don't fail because people lack information. They fail because people ignore uncomfortable information. Late cycle risk isn't hidden. It's simply inconvenient. And the price of convenience in markets is always paid later. That's why preparation beats prediction. Always.